Well, Friday is, speaking of new jobs, Jobs Day. Labor Department publishing, of course, the May numbers. We're going to get a look at that. Economists expecting the unemployment rate to stabilize at 3.9%, with the expectation for 185,000 jobs added. In April, the economy added a weaker than expected 164,000. Of course, investors are going to be watching that report on Friday, but there's a lot to talk about today. Let's bring in Mark Avallone of Potomac Wealth Advisors. Hey, good morning.
Good morning.
I want to talk about the jobs issue in a second, but first I want to ask you about this sell-off that we're looking at right now. We've got the pre-market down. Dow was down more than 200 points a few moments ago. We're kind of coming back a little bit, but still a lot of pressure. We're down 193 right now in the pre-market for the Dow. What do you make of this?
Well, I think a lot has to do with the uncertainty we're seeing out of Italy. You have an elected populist movement there being suppressed by the entrenched bureaucrats, and how that impacts the relationship with the greater Eurozone. Markets don't like uncertainty. Italy's a huge issuer of debt. I think that's what's happening here. It's just more of a pause because there's some global uncertainty. Third
largest economy in the Eurozone, and if you've got pressure on them to basically break away from the Eurozone, and that's what these factions want, you've got another, Brexit story potentially in your hands. Okay, let's talk about the jobs report here in this country coming up on Friday. I mean, we're at 3.9% unemployment right now. We haven't seen these levels since 2000. But wage pressure, we have not really seen the wage increases that we would really need to see to really say that this is a success.
Well, there's been subtle wage pressure, and we had almost a decade of stagnant wages, and now a movement into the 2.5% annual wage increase. It's actually a really good number. It's enough to put money in the consumer's pocket and help drive the U.S. economy, but it's not toward enough to make the Fed put the brakes on this by ratcheting up rates. So I actually look at the 2.6% wage increase as a good number for just about everybody involved.
Yeah, and when I say wage pressure, obviously that could be a negative force, but maybe things will change on Friday. We'd like to see that number tick up, as well as the unemployment, as well as the participation rate. Let's talk about the Fed. You mentioned this really briefly, but let's talk about that because, the meeting is next month. The expectation is, we're probably going to get another rate hike, but it's that fourth hike that investors continue to kind of be rattled about, that potential fourth hike.
Well, that's a long way off, but what we're seeing is the most important person in Washington is Jerome Powell, the head of the Fed. He's the one that's going to drive this market, and the Fed is going to be the entity that determines the length of this rally. If the Fed sticks to some strong rhetoric and a structured and repeated rate hike, you're going to see that being the biggest headwind against this stock rally. Corporate earnings are strong, global growth is strong, the labor market, the consumer, they're all moving in the right direction. It's just how strong will those forces be, and how reactive will the Fed chair choose to be?
Well, if you read the minutes last week, not that reactive, and that was a market bonus, at least on that day when we got the minutes. Well, we shall see from Jerome Powell. I'm stealing that line, by the way, Mark.
Okay.
Mark Avallone, thank you very much.
Good to be here.